Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, excited for my guest this week. We got Matt Wagner, who's the founder of Accommodation Capital. He works with investment boutiques and institutions. Prior to establishing Accommodation Capital, Matt was a partner at XXI Securities, a boutique advisory firm specializing in tax and hedging transactions for professional investors. The unique capabilities of XX1 allowed Matt to work with a broad array of investors, and his diverse collection of firms that he works with currently has only added to that mix and obviously added a lot of value. His network includes many of the nation's most prominent family offices, multifamily offices, corporations. Additionally, there's an increasing exposure to large public pension funds and sovereign wealth funds. So he likes to be, mission aligned with different firms and just focusing on added value, investment strategies and ideas. And his web of contacts, as a super connector, helps him provide clever, unique opportunities and strategies to partner. So Matt, welcome to the show. Thanks for popping on. Really appreciate it.
Thank you.
Yeah. Well, maybe you can start with, your background, maybe double clicking on kind of the high level bio that I gave, but tell me a little more about your industry experience, kind of working in the industry, maybe what you studied in college and how that kind of transitioned to, your first steps in your career. And then obviously setting up a couple great, investment firms and advisory shops. And then I think down the line, we can go through kind of your investment, viewpoint and kind of what you look for in companies to invest in.
Sure. I by way of background, I went to undergraduate at the University of Cincinnati, and I studied history and economics, and then went to graduate school at Columbia at their School of International and Public Affairs. Also took finance and East Asian area studies, Chinese and what have you. I ran a brokerage firm in Washington, D.C., managed a branch of a brokerage firm that was merged out of existence in the late 80s called Laidlaw, Adams & Peck. And a guy who had originally hired me at Laidlaw had left Oppenheimer and started a firm called 21st Securities, aka XXI Securities. And
Sure.
21st was a specialized firm that basically mimicked the desk that he ran at Oppenheimer that crafted tax and hedging strategies for professional investors generally. Most of my clients were big corporations and hedge funds and what have you. And that sort of imploded in the mid around 2026, 2027. Mm-hmm. I set up Accommodation Capital, which is really a placement agent. I also work with another platform, Credo Capital, which is where the main platform that I work from, which is a placement agent that was started by an ex-Lazard banker, and it's populated by wayward bankers and brokers of various stripes. And everybody sort of runs their own business. Most people, I think, raise money for fund managers, which is probably pertinent to your audience.
Sure.
Most of the stuff I do is more direct transactions. So my business tends to be a little idiosyncratic, but I work for projects that I believe in and I think make sense. Everything from selling commercial real estate, a building in Honolulu not too long ago, to raising money for an airline, to raising money for a digital textile printer business. And I'm in the midst currently of looking for acquisitions for a SPAC that was launched in January and raised $300 million in their offering, and have another couple $1 billion in PIPE financing, and are looking for companies to acquire. If you don't know anything about SPACs, there's a meter running when they launch, and they need to deploy the capital within 18 months or return the money to their shareholders. So everybody's in sort of a mad scramble to find a good fit. They've hired an investment bank. I'm actually working at the request of one of the board members, who's a longtime friend and colleague. And that's basically how Joel and I started talking, and how I found myself on this podcast.
Yeah, well, thanks a lot, Matt. I mean, I think a couple things to unpack is kind of the placement industry. So, what are some observations that you've seen in the evolution of that career? Obviously, I mean, I think people that are good at relationship building, people that are good at business development, building an investor pipeline. I'm assuming that's how you got these big clients in your past role that were large corporations, large family offices. So, how has that industry and career path changed in the last maybe 5 years, or has it been exactly the same?
I would say it's less less family offices. That's actually a fairly recent development in the last 5 or 10 years. They've become increasingly more institutionalized, I find. I don't think that's a particularly original observation. Corporations became clients because they had specific tax attributes that could be read off a 10K, and had ideas to address them. Same is largely true with hedge funds, for that matter. It's an eclectic mix of people, and I think that's one of the advantages of working in sort of tax-driven transactions, is that you meet a lot of different investors and pools of capital. And my work since then has been less tax-centric, with the exception of credits, basically corporate credits. That's been the government, in its infinite wisdom, has created a whole passel of incentives to channel corporate capital to various industries and pockets. Low-income housing is probably the most well-known, but it's lots of renewable energy and so forth. So it's a grab bag of things that I do, but it's meant to take advantage of contacts built over many years.
Some of your colleagues were helping fund managers raise capital on the IR side. So when's a good inflection point for a fund manager to take on somebody to help them raise capital? Is it when they've hit a certain AUM, when they've hit some type of milestones? Because I'm assuming, like when you start the investment firm and the platform you're building, hopefully it's a multi-decade platform, you're the brand in the beginning, and you're probably going to get some seed capital to start the fund. And then I'm assuming later on, that's when you bring in, IR agencies and professionals. But have you seen people kind of start building that extended team on day one, saying, look, I'm planning to launch $100 million fund. I want to get, as much help as I can right now. Do you think that's a good point to get additional outside help, or do you think it's better down the road?
For me personally, I think it's better down the road. I mean, I would be reluctant to get involved in a first time fund for a host of reasons. There clearly are people and firms out there that do that, but that's a tough road to hoe unless there's extenuating circumstances, a particularly clever strategy, a particularly interesting lineage. If it was a star for Soros Fund Management or something, that would certainly make a difference. But typically, I think that I generally don't like to get involved with fund managers for That's even experienced ones. That's a tough road to hoe, and I don't really personally have the patience and
Yeah.
and frankly, network of connections that would best suit that. They're better people than me at that.
Yeah. And then, kind of switching gears to your expertise now, which is more of the direct deals and obviously the SPAC transactions. From my understanding, a SPAC is essentially kind of like a bag of money, and then they have to find a SPAC target to de-SPAC. Is that kind of the process?
That's a pretty good summary. Yes.
Yeah. And I've been to a few dinners, being in New York for a pretty cool investment bank that had some of their portfolio companies there. But, what I've seen is, they're looking at companies that are at a certain revenue. So I was sitting next to a couple founders that were at like over 100 million in revenue. And that was kind of maybe the parameters that was set. But, I guess when you're looking at, potential SPAC targets, what are kind of some of the criteria that you look for, maybe on the qualitative side and on the quantitative side?
Well, the SPAC market is currently rather bifurcated, and that a lot of deals are getting done with what I would characterize as sort of trendy industries, nuclear, modular nukes, and anything AI related, quantum computing. Those are some of the highest flyers in the market, and some of the things that get done. The group that I'm working with and for in this instance, Aldabra, is they're more old school players, which I am as well, as you can see, and they're looking for cash flow stories, and or big investors looking for liquidity, like an aging founder who's wants to a private company might want to unload a large equity position, or maybe a company that's filed an S1 but never went public, or something along. Liquidity situations are generally the best match. In terms of company, we're really both geography and industry agnostic, but again, ideally you'd want something with 50 to 150 million of EBITDA, and in a business that's easy to understand, with a defensible moat, and a very clear runway for future growth, I would say.
Sure. What are some of the industries that you're really excited about? And what are some that you think are less attractive to invest in?
Well, for this specific transaction or generally?
I'd say generally.
Oh, I don't know. There's so much is happening in the technology sphere at such blinding speed that it's hard really to keep up with it, frankly, or my base of knowledge isn't so deep that I even understand some of the things that are being done there. I tend to like businesses that are out of favor. Again, much like the acquisition targets, easy to understand, defensible moat, clear runway for growth, and I think there are a lot of industries that are spooked by AI, and what's that going to do to their business model? What's that's going to software companies most obviously, but many others, from a pure what's it going to do to the labor market? For one instance, I was looking at a private company that is rolling up, in effect, trade schools of various trades that won't be affected by AI. Jensen Huang said, become a plumber. That you're always going to need that.
Or electrician, right? I mean, they got all these data centers now, so electricians are going to be more in vogue to be able to maintain all the maintain all the infrastructure.
The only part of the labor market that's really expanding right now are the healthcare workers,
Sure.
nursing schools, things like that. So I'm trying to hit it where they ain't, as Wee Willie Keeler famously said.
Sure. Talk to me about some of the family offices and multifamily offices. And, one thing that I've also noticed too is many of them are becoming institutional. So their infrastructure is pretty much set up like an endowment in some instances, or they're set up almost like a pension fund where they have, a CIO, an investment committee. Sometimes they hire like an OCIO to kind of manage a lot of their corporate structuring and infrastructure. So, in terms of the interest from family offices, I would assume like the families that come from like a business family, they're going to be much more entrepreneurial and probably roll up their sleeves and help some of the portfolio companies that they invest in. Where there's others that are just kind of essentially building an investment firm within their family. But we'd love to hear your take on that in terms of some of the families and MFOs that you work with and things to keep in mind.
I think that that's a pretty accurate description of the lay of the land. The multifamily offices are, they're I think a little loosey or goosey than the single family offices that have a more institutional framework, higher, I think, higher caliber talent for the most part. They have a focus that's largely driven by the business that created the fortune. Much like a corporate venture capital firm represents the interests of the corporation, I find that family offices have kind of a similar cast, and with obvious look to diversify and prudently as well. But in terms of private equity, in terms of venture capital, I think it's fed by the founders' interests.
Sure. What stage are you seeing some of the families get involved in? Do you see a lot of them showing more of an interest towards growth equity because there's less risk and obviously proven revenue coming in? Or do you see some families kind of have a mix in their portfolio construction where some of it's early and then some of it's more late stage?
I have a limited universe to make this observation, but
Sure.
I find that it's a mix of the two.
Mm-hmm.
I think there's business, again, if it's a business that they understand or have some background in, they're more likely to get earlier in the game. If it's something a little further afield, it's more classic growth equity.
Sure. Yeah, that makes sense. What are some of the, what's your investment process when you're sourcing and screening deals, when you're kind of looking through them? Do you guys have like an investment committee? Would love to kind of learn, kind of your process. That might be helpful for just best practices for other emerging fund managers.
It depends on basically how it was sourced to me. It's probably part of it. Referred by somebody I know. It takes on a greater importance to me or more seriousness. Certainly look at the principals involved, to the fund manager, if that's the case, or the CEO of the fledgling business, if that's the case. And how they operate and what their experience has been thus far, and what's their value added, and how big is that potential market, and what do they bring to it that nobody else has? I mean, the basic questions that I think anyone would ask. I don't, but that's such as it is. That's the process.
Sure. What tips do you have for someone that's looking to kind of either get into IR or maybe, try to build their own LP pipeline for their first or second fund? What are some tips or techniques that you've recommended over the years when people are trying to just build that investor community and kind of get to their first close, or just kind of, build rapport relationships with LPs?
Yeah, I mean, I think it's best if you can obviously have a grub stake from a high profile investor. Maybe it's a manager you work for. Maybe it's something like that. As you know, many do start that way, and that's if you have that luxury, that's a great way to start. Some people work networks of various seminars and talks given by investment banks, or there's a whole industry of people devoted to putting together speaker platforms and confabs of one kind or another to try to pull in both interesting new product and investors. There's too many of those to thumb through. But you would know much more about that than I would. I'm generally old school. I think of who are the obvious end users for what I'm in the midst of, and I get on the computer and get on the phone and find them. It's not much, for all of the technology, you can do a lot to save time and productivity, but it really kind of boils down to the same basic principles.
Yeah. What if you had to choose between just going to a really great event and, having your own event? What do you think would get a bigger ROI?
Depends where the great event's hosted, I guess.
Yeah. The usual suspects like iConnections, whatever those capital intro conferences are, versus obviously there's time and effort and obviously labor to and expenses to kind of do it yourself. But in terms of that, I guess, what do you think would be better?
I think the big events are, for the right person, a very good venue. I would say I'm probably not the right person for that, just my personality. But I think if you're young and you're starting out and you've got a story to tell, it's a very effective way to get on podcasts like this or go to big events. It's a smart way to do it.
Yeah, that's great. Well, Matt, really appreciate all your time. I think we learned a lot about just kind of the whole, asset management space and kind of how IR plays into that. I always wrap up every podcast with just one piece of advice. If you got a piece of advice from a past colleague, a mentor, a family member, whatever you want to share with us, we'd love to take that away with us.
Yeah, don't work with assholes.
Yeah, I totally agree.
That's my advice.
Yeah. You want to work with people you enjoy working with, and hopefully you can grow together with them. So timeless and advice I agree with. Yeah. Awesome. Well, thanks so much, Matt. Really appreciate it.
Thank you.
Yeah. Bye.